The three-fund investing strategy is a simple way that you can manage your own money while still outperforming the majority of retail investors and even most professional money managers. Using this investment method, you will save yourself a huge amount on fees, but also on time and energy, because you don't need to spend hours poring over income statements and balance sheets trying to pick and choose individual companies whose stock price you think could go up. And the best part of it is that not only is the three-fund investment strategy so simple that literally anybody can do it, but it can also be used by people that are investing any amount, from $1,000 all the way up to $1 million or beyond. So in this video, I'm going to show you the benefits of using this investment strategy, as well as give you a step-by-step blueprint on how you can create your own three-fund portfolio in a matter of minutes. For starters, what is a three-fund portfolio? It's where you choose and invest in 3 index funds that give you broad, diversified exposure to the entire stock and bond markets, including the US, but also globally. And with this strategy, you'll be investing in pretty much every notable company around the world, from the Googles, Amazons, and Microsofts, all the way down to small or medium-sized companies that have growth potential. Now, at this point, you might be asking yourself, is it really a diversified investment strategy if you're only investing in 3 index funds? In short, the answer is yes, because if you buy one share of a broad market ETF, for example, something that tracks the total US stock market, then you are effectively buying tiny fractional amounts of the thousands of companies that make up that index. And as you'll see in a minute when we talk about the specific ETFs that you might want to own in a three-fund portfolio, these index funds are going to give you exposure to literally thousands of companies for the price of a few dollars per share. So what kinds of index funds should be included in a three-fund portfolio? Well, it really depends on your age and your risk tolerance. Now, the typical three-fund portfolio is going to have these 3 things in it: a total US stock market ETF or index fund, a global market index fund, and also a bond index fund. And the percentage allocation of your investment to each of these different funds is going to depend on what your risk tolerance is and what type of results you're looking for. So for example, a younger person, maybe with a higher risk tolerance, would want to invest more so in the stock side of things and probably have a smaller investment in bonds, versus maybe an older person that's getting closer to retirement and probably has a lower risk threshold is going to want to invest more heavily in the bond side of things as opposed to stocks. Now, in a couple of minutes, I'm going to show you a few strategies that you can use to take the three-fund investment strategy, but boost the returns and also the risk profile. But for now, let's take a look at some specific ETFs that you might consider including in a three-fund portfolio. These 6 ETFs, 2 in each of the categories that I just mentioned, will give you enough choice. And I'm using the Vanguard and the BlackRock versions of these ETFs for the different categories, but of course, there's many other ones out there. Let's briefly touch on each one of these ETFs and see what's actually included. If you invest in these funds, what are you getting? So if we zoom into the US stock market options, the first ticker symbol on the list is VTI, and this is Vanguard's total stock market ETF. You can currently invest in VTI for $209 per share. And for that price, what you're getting is exposure to 3,824 companies listed on the US stock markets. This ETF is invested in every sector in the US economy and has exposure to the largest companies in the world, including Apple, Microsoft, Amazon, etc., but also to smaller companies as well. And the expense ratio for this ETF, meaning how much you pay per year to invest in this fund, is 0.03%, which is super, super low. Now, the other main option for the US market portion of the three-fund portfolio is ticker symbol ITOT, which is the iShares or BlackRock version, and it's basically the same thing, except the shares of this one trade for $92.85. But it has the exact same expense ratio, and it's going to have pretty much the exact same results as the Vanguard ETF. So either one of these is going to be a good option for that US portion of your portfolio. For the global portion of the portfolio, what we're trying to do here is gain exposure to other markets around the world, excluding the US, so that in case there's geographic risks, for example, if the US stock market underperforms for a specific period of time, well, it's possible that other markets around the world could outperform. So we want to invest not just in the US, but all around the world. And Vanguard has an ETF that goes by ticker symbol VXUS, which is the total international stock market excluding the US. Now, the expense ratio for this one is a little bit higher at 0.07%, but it's still less than 0.1%, and it's a little bit higher because the asset managers have to rebalance this portfolio in many different countries all around the world, so it takes more work. You can buy shares of this ETF for just under $52 as of the time of this recording, and for that price, you're gaining exposure to 8,579 companies all around the world. If we look at the geographic breakdown, you can see that 25% of the portfolio is allocated to emerging markets, so think India, China, etc. But then you have also major allocations to the European market at nearly 40%, the Pacific, so we're talking about like Japan and Korea, and then also North America, excluding the US. The BlackRock version of this ETF is ticker symbol IXUS, and it is again a very similar product with the same expense ratio and more or less the same coverage. Finally, for the bond markets, we have Vanguard's BND fund, which is the total bond market ETF. It's currently trading just under $69 per share, and this one also has a very low expense ratio at 0.03%. And what you're getting with this fund is exposure to different bonds, majority of which are US government bonds, but you also have corporate bonds at different rating levels. So AAA being the best corporate bond and BBB being the worst one that's at least held within this portfolio. And this bond fund is meant to reduce the overall risk of the portfolio because it decreases volatility, it has much more steady price, and it has cash flow yield. Each of the bonds that are held within this ETF pay out a coupon rate, which is a payment to the bondholder, and those payments get rolled over to the holders of the BND ETF in the form of dividends. Finally, a similar fund from BlackRock in this category would be ticker symbol IUSB, and you can purchase this as a replacement for BND. You don't want both. All of these ETFs would be good options in a 3-fund portfolio, and I gave you 2 examples in each category for a little bit of choice. So now that we know what ETFs to include in the portfolio, we're almost ready to open up a brokerage account and actually start investing. But we need to actually talk about what's the allocation. How much money in your portfolio should you allocate to each one of these categories? Well, like I was saying before, it depends on your age, but also your risk tolerance. So if you're young and you have a long time until retirement, and maybe if you have a higher risk tolerance, then you can swing for the fences a little bit more, and your portfolio allocation might look something like 80% stocks and 20% bonds. That would be considered an aggressive strategy within this 3-fund portfolio. And inside that 80% stock allocation, you want to allocate a significant percentage of it, the majority of it, to the US stock market. And only a much smaller percentage of the total amount should be allocated to the global market as a way to balance any geographic risk and also increase your diversification. So an aggressive 80-20 portfolio might look something like 60% US stock market, 20% international stock market, and 20% bonds. If we look at the historical data on this type of portfolio, you can see that this investment allocation will perform better over the long run, but most especially during bull markets. On the other hand, during market downturns, an 80-20 stock split will perform significantly worse than a portfolio that has a higher allocation towards bonds. So considering that, as people age or get closer to the retirement, or maybe if they just have a lower risk profile, then they're going to want to start to allocate a higher percentage of their total portfolio towards the bond side of things. And that transition can happen slowly. So you can go from 80-20 to 60-40 to 40-60 to 20-80 favoring bonds. At an 80% allocation towards bonds, your portfolio will definitely underperform in bull market periods. But if there's a bear market or an economic downturn, then it's going to have much less volatility. And that's why it's better for retirees or people that want to maintain their nest egg and keep cash flow coming in, and they don't want to see big swings in the value of their investments. But it's definitely not advisable to invest too heavily in bonds too early on, because then you'll be leaving a lot of money on the table in terms of capital gains over time. Now, if you're not sure where you fall on the risk tolerance spectrum, I'll leave a link down below to a quiz that you can take that will give you an idea of what sort of allocation you should think about using for your portfolio. Okay, so now that we have a good idea of what ETFs to invest in and what percentage of the total portfolio to allocate to each category, let's backtest this strategy and take a look at what the results of investing in a portfolio like this could be for you. And then after that, we'll dig into some ways that you can actually spice up your portfolio and potentially boost your yield if you're interested in taking on even more risk. So this website here, portfoliovisualizer.com, allows you to backtest different types of investment strategies. And so what I've done down here is input 3 different portfolios based on the strategy that we just discussed. Portfolio 1 is 60% US market, 20% international stock market, and 20% bonds. Portfolio 2 is 30% US, 30% international, and 40% bonds. And finally, portfolio 3 is 15% US stock market, 5% international, and 80% bonds. So we're going to take a look at what the results of these 3 different portfolios have been. So let's hit analyze portfolios and see what we get. And this is what the results look like. Now, this is assuming that you started with $10,000 and invested an additional $10,000 every single year. Well, portfolio 1, being the more aggressive 80% towards stocks, would outperform the others. And you can see that over time, it starts out pretty close, but as we go longer and longer in the duration of the investment, it opens up a larger gap on the other investment strategies. And so under this scenario, the conservative bond investor approach would have $150,000 invested as of the end of this test, but the middle portfolio, which is more of a balanced portfolio, would have $176,000, and the more aggressive stock portfolio would have $212,000. Now, considering the results here, you might be wondering, why would anybody ever actually allocate more money towards bonds? Because it's clear that over the long run, the stock market outperforms the bond market. Well, let me show you exactly why, because if we scroll down here to see the different annual returns over the last 10 years or so, you can see that in some years, for example, 2015, the market was down, but the bond investor was actually marginally up. And same thing in 2018, the markets were down, but the bond investor was down significantly less. And that's why it's great for retirees that are trying to preserve their nest egg and to maintain cash flow, because you want to minimize risk, you want to minimize downturns. You're not trying to, at that point, maximize gains. Now, this is a very, very important point that I need to make. This strategy only works if you actually commit to it for the long term. It's definitely hard to go through bear markets and see your investments in the red. But if you sell everything because you get cold feet when the markets are down, then not only are you going to be locking in a loss, but you are also going to be giving up the opportunity to buy more while the prices are low, which would over the long term increase the gains on your portfolio and allow you to achieve financial freedom even earlier. And studies have shown time and again that the best long-term investors are the ones that buy and hold and simply dollar cost average in no matter what the market is doing. And that's why the 3-fund portfolio strategy is perfect, because it's set up so simply that it makes it incredibly easy for you to just continue to buy into your asset allocations each month and each year, regardless of whether the market is up or down. And if you commit to this strategy and invest over the long run, then you will see those results. Now, let's take this to the next level, because once you get comfortable with the basic 3-fund investment strategy, there's ways that you can actually boost your investment returns over the long run by taking on additional risk if that's something that you're interested in. And to do this, you still don't have to go out and pick individual stocks and investments. What you can do is simply add a 4th ETF to the portfolio that gives you targeted exposure to a specific industry or sector or type of investment that you believe has outsized potential over the next 5, 10, or 20 years. This could be something like cryptocurrency, it could be AI, it could be clean tech, whatever you're interested in. There are ETFs out there for pretty much every sector of the economy. And so if you have been doing your research and you're interested in managing your portfolio a little bit more actively, and you think that a particular sector has a chance to outperform the total stock market over the next few years, then this is a great way to increase or boost the yield of your 3-fund portfolio by allocating a small percentage towards it. So let's say 5 or 10% of the total amount max. And what this can do is really increase the returns of your total portfolio if you're right, while still managing your risk to the downside. In the best case scenario, let's say that you invested in an AI ETF, and 10 years from now, the price of that ETF 10x's. Well, that means that your portfolio returns are going to be boosted significantly because that is in your portfolio. On the other hand, in the worst case scenario, let's say that the AI industry is a total flop and the price of that index fund reduces by, say, 50% or 75%. Well, if you've only allocated 5% of your total portfolio to that specific sector, then you're still going to be fine. You'll be taking a small hit, but that will be more than made up for by the gains in your other more basic index funds. Now, to give you an example of what this actually looks like in practice, I'm going to show you this demo account that I made for my channel here, because this is a max risk 3-fund plus 1 portfolio strategy. Now these ETFs are listed on the Canadian markets, but I'm following more or less the same principle. I've invested the vast majority of this, over 50%, into the US stock market, and then I have smaller allocations to the international market and the Canadian market, but I also have an allocation to the Evolve Cryptocurrencies ETF, which is a Canadian stock market listed ETF that tracks both Bitcoin and Ethereum. Now this is obviously a risky sector to be invested in, and it increases the volatility of the portfolio, but as you can see over the last year, it's up over 50%, which is significantly outperforming the total stock market. Now because it's up so much, it's actually higher as a percentage of my portfolio than I would like it to be, and I need to do a little bit of rebalancing because it's currently at 10%, but you get the idea. And that's really the final point that we have to talk about, is that over time, your different investments in the different funds are going to move, and it's going to change the percentage allocation of your portfolio, whether or not you're putting more money in. And so over time, it's a good idea to, if you're continually putting more money in, make sure that your allocations remain close to what your target percentages are. It doesn't have to be exact, but relatively close. And if it gets really out of whack, for example, in the case of my cryptocurrency ETF, then I probably should consider selling some of it to bring the allocation down closer to what I actually want it to be. And that's a good way to manage your risk over time and to make sure that your investment strategy stays consistent. So hopefully you found this video helpful, and if you enjoyed it, you might also like this one right here. Thanks for watching, and have yourself a great day.